Hi everybody, thanks again for joining for the third session of Nirvana. In this session, we're going to talk about the remaining two aspects or sections of the annual report, starting with the auditor's report. So in the auditor's report, technically it's a communication of the auditor's opinion on the financial statements of the company. Generally, there are two kinds of statements: standalone financials and the consolidated financials. A consolidated financial is where the company has subsidiaries which have material cash flow or revenue or profit, which means there is a parent company and then there's a child company which is called a subsidiary, and there is enough revenue or cash flow or profit that is material to the parent company's operations. So that is when you have standalone, which talks about the parent company's financials, and then there's a child company whose financials are also integrated in the consolidated financials. So again, in the auditing of a particular company, there are two kinds of audits. There's a statutory audit where the auditor is voted and decided upon by the shareholders through a vote and consent taken from shareholders. But an internal auditor is hired by the company or by its management. The job of an internal auditor is to look at any errors or look at accounting systems, processes, and refine them from time to time and ensure they are on par with the required standards. While the statutory auditor's work is the entire audit, which is key to preparing the entire financial statements which is published in the annual reports, which is shared with the public. So these are two different types of audit that we are talking about. So the auditor's report, which we are going to analyze or understand in this session, is going to be the statutory audit. Now, in the auditor's report, there are different kinds of opinions and details. Now, in terms of opinions, this is not the traditional opinion that I'm talking about. There are four kinds of accounting opinions that an auditor could take up. The first being an unqualified opinion. Now, these terms and the names might be slightly confusing, so please listen to this carefully. As unqualified opinion is when the auditor feels that there is everything right with the company. Again, I repeat, when they feel that everything is right with the company's financials, the company is following all the right corporate governance practices, accounting frameworks, the standards are met, and the entire data has been shared with the auditor, and they have no questions or any doubts on the authenticity of the financials of the company. And that is when an auditor gives you an unqualified opinion. This is the opinion that most investors want to see with their companies. This means that everything is good, and whatever is being shared is something that you can believe in, basically. The second kind of opinion is qualified opinion. Now, while the name is positive, it actually depicts that the auditor feels that there is something amiss, or there are a few questions or data that they do not have, or they're unable to make a reasonable conclusion that everything is okay. Now, the way a unqualified opinion report or a qualified opinion report is written is pretty much the same, but then in a qualified opinion report, the auditor mentions the reasons why they were not able to achieve an unqualified opinion status. For example, in some particular segment, there were 2 or 3 related party transactions or general business transactions that were not explained well by the management, or it was not explained to the satisfaction of the auditor, is when they will flag those things and say that these are some things we are not able to say with confidence that these are authentic or genuine transactions. Now, this is not really a great sign for the company, but again, not as bad as the other two opinions that we are going to discuss about. Investors typically don't like having a qualified opinion on their company's audits, basically. So this is something that you need to keep an eye out for. And remember, unqualified and qualified do not represent negative and positive in the traditional sense. Their names are typically opposite, so please don't get confused. The third kind of opinion is disclaimer of opinion. Now, in this situation, the auditor actually is distancing themselves and saying that we cannot give an opinion on the company's financial statements at all. Now, this is even more negative, harsh, or adverse than the previous one, because here they are refraining from even making a statement on the financials. Now this could be because the management has not been cooperating with the auditor, they have not given enough data, or the satisfaction levels with respect to what kind of transactions are they, genuine authentic transactions, the auditor is unable to make a decision. So this is when a disclaimer of opinion is given by an auditor, and this is very negative, and generally investors and shareholders look at this from a very negative angle, and this also in most instances represents or indicates that there is something amiss with the company's financials and the overall business health basically. So there have been many such instances. Again, the example of where Deloitte had to resign from being an auditor of Manpasand Beverages back in 2018, which went on to have its own shares of troubles and frauds that were exposed, whether it is GST or the likewise. So while this cannot be called a disclaimer of opinion, but the auditor had complained that there was not enough data that was given by the company, especially on the capital expenditure and revenue aspects of the business basically. So there are many such instances that you need to be very careful about, and while a lot of formality and standard language is used in the auditor's report, don't miss any part of it, please read it thoroughly. The fourth and the last kind of audit opinion is adverse opinion. In this situation, it means that the auditor has gone through the financials of the company and has come to a conclusion that there are gross misrepresentations, misstatements, and a very high chance that there is a fraud in the company's accounts basically. This is the most negative kind of opinion that a company could get, and it clearly signals that there is something wrong with the company's business and its financials. Investors have to be really careful with these kind of companies. The next important aspect that you need to check in this section is the reputation and quality of the auditor themselves. So for a company's revenue and profit size, for example, a company with 10,000 crores of revenue and say 1,000 crores in profits needs to go with a reputed auditor who has the scale and the operational capabilities to look into a company of that size, right? So now there is no particular indicator or perfect measure which says, hey, this is a good auditor or they are not a good auditor, but then you can look at the history of the auditor by just doing a simple Google search, see if they have been working with clients who have an impeccable reputation, or if their opinions have always been transparent and unbiased, and whether the company or the auditor, has the scale to work with a company of that particular size. So it's not just the company's financials that you have to look for, but you also be careful about the kind of auditor that the company is engaging with. So if a very big company is going to a really small setup or a different kind of a professional who doesn't have the bandwidth to look at the details of the business, there could be underlying reasons which are generally not in the interest of shareholders. So it is important that the company works with professionals who have a good reputation, good standing, and the technical expertise required to look into the financials of the company in depth. Now moving to the last and final section of the annual report, which is the financial statements. Now we are going to only look at financial statements from a very broad angle here before we move to the next session where we have a lot of details that are going to come up. And financial statements generally include the P&L, profit and loss, balance sheet and cash flow. And there are two kinds of financials, standalone and consolidated financials, that we just discussed about. So a company has a lot of narration, commentary and notes to financial statements, which are as important as the statements themselves, because these notes are those stories and rationale that I've been talking about, which explain why a particular number has behaved such way, and why there was a decline in that particular value or a growth in such value, where the company tries to attach reasons to the financials. This is very important. The notes are generally very extensive and very comprehensive. You might encounter fatigue, especially after reading so many pages. So please take a break if you need to while reading annual reports, especially in the financial statement section. And the notes to financial statements have to be referred in the context and end to end without missing any single point. We will go into the depth of what these notes mean and how to analyze a particular financial statement in the next session. But for now, it's a wrap on our 5-section analysis of the annual report, where we explain to you what are the general categories, the components, the inclusions, what are the important in pieces of information and insights that you have to be focusing on while reading an annual report.